Hello everybody, thank you for joining our second webinar where we will be discussing money management during a crisis. This is a follow-up to our previous webinar, which we will have linked down below. In that webinar, we discuss how to protect your credit during a global pandemic. Today, we're joined by John Simpson, RentReporters CEO, Sue Katz, American Consumer Credit Counseling Community Outreach Coordinator and Certified Credit Counselor and Educator, and we're welcoming back Amy Thomann, TransUnion's Head of Credit Education. And they will be discussing a study done at TransUnion to understand how Americans are being financially impacted by the global pandemic, how to budget and set some financial goals, help you better understand your credit and what impacts it so that you can build or improve your score, and lastly, how to manage your credit and debt. I'll let Amy take it away with TransUnion's financial hardship study.
So we're now in our 12th wave of the study, which just came out a couple weeks ago. And we found that at the current time, more than half of Americans are still, reporting that their income's been impacted by the COVID-19 crisis. This isn't surprising. It's actually gone down a little bit just due to some of the reopenings that have happened, we think. But we know that this is just a really difficult time for so many. And ultimately, now that we're back in the fall, we also have schools reopening, and that whole situation has been, a real struggle for people as some schools have not reopened. There's a lot of virtual learning, there's limited capacity and things like that. And on my next slide, you'll see that we have 86% of families who have been impacted by school changes like virtual learning have had to adjust their budgets because of that. And, so I think really the call out here isn't to say, everything's just so awful. I think everyone is feeling it in their own way, and we do know there's an impact. This is really just to say that there are a lot of different ways that families' budgets are being impacted right now, both directly by COVID and job loss, as well as by some of the impacts that are happening because of social distancing and virtual learning and other events. So, it's that people aren't alone, ultimately. And so we're also polling how people are handling their finances because of that. So we're seeing now that although people continue to do, really common things like take money out of savings, as well as, as well as turn to new credit, we're starting to see that that's increasing. And so I think this webinar comes at a really opportune moment to show that, it can be really demotivating to try to make financial plans or try to manage your budgets when finances are so tight and we are in a difficult situation. But there are a lot of resources available to you, us included, and also that understanding what your goals are and what bills and what your budgets are that are most important to you are kind of the key to making really productive financial decisions from here that will then help you recover and kind of manage and protect yourself as you continue through this situation and continue to come out of it over time.
So Amy, as I think about, there's a few things that you said, but the one that I think that it maybe is most important for a baseline for today is that this is something that we're all experiencing. When you look at the, it's certainly unprecedented, obviously, but to see so much of the country impacted. And the reason why I wanted to point this out is because too often when it comes to credit and it comes to finance, we can take on this cloak of shame that we think that we've done something wrong, that we're not responsible, that we overspent. And inevitably there's going to be instances where that's true. But I think that wall or that cloak of shame, and Sue, I'll ask you to jump in on this in a second as well, that cloak of shame can prevent us from doing the things that we need to do, the hard things to protect ourselves. And so I think it's really important that nobody here is alone. This is something that the country's experiencing. Is that what you see, Sue?
Well, I actually do see it a lot, and life happens. Nobody is immune to it. Doesn't matter how much money you make, it's what you do with what you have that counts. And by learning to budget, by using your resources, it makes it so much easier when a time like this happens. So, getting on track with what your goals are, like Amy said, and knowing that you've got a plan of action and resources out there to use, maybe even your local 211 with Easter seals and other people that might be able to give you a little helping hand too. We can make it through anything.
Sue, what you said 211, what does that mean?
211 is a phone number that people can use in every state that gives you emergency services in your state. So it might be something like Easter Seals, who may have grants or food distribution or COVID testing, or it could be the Salvation Army, different organizations. American Consumer Credit Counseling is listed with 211 as well. So we can be found there too.
Sure. I didn't know that. That's incredible. What a great resource. Thank you.
Mhm.
Amy, as I'm looking at the slide that's in front of us, 21% increase in the available credit use, meaning they're using more of their credit. 14% are looking to refinance or renegotiate rates. I guess that middle column kind of falls under our accommodation, perhaps, conversation from last time. And 13% are opening up new credit cards. One of the things that jumps out at me is that we certainly want to use credit to help bridge our financial needs during a crisis. But I also, what I worry about, and I don't know if you or Sue share this concern, but I worry about use of credit without a game plan to repay.
Absolutely.
Jumps out at me
Totally.
here.
Yeah, absolutely. Credit is a valuable tool to use if used responsibly. And, of course, in a situation like this, sometimes you have to turn to those resources. That's why it's available. But there are things you need to keep in mind, like your credit utilization rate, as well as what accommodations are available to you if you're struggling to meet those credit card bill payments, if you are having to turn to credit, or if you are choosing to turn to credit to meet your gap. Credit utilization rate is how much of your available credit you are using. It's generally used for credit card usage. So if you have two credit cards that both have a $1,000 limit, to keep it really basic, if you're using $200 of that limit, that's 10% credit utilization, as a really basic example. So the goal is to keep it as close to zero as possible, of course. That's always the ideal state. But, if you're having to use a little more, generally the rule is that if you can keep it under 30%, then lenders are still going to look at you favorably in the sense that they see that you're being responsible with credit, you're paying back, any big charges within some type of reasonable time frame. And so trying to keep it within that 30% can be a way that you can use that tool available to you, but still use it responsibly if you're able.
Sue, what are your thoughts on use of credit?
Oh, most definitely. The higher you get to your limit, the lower your score is going to be. I usually say, like I said, life happens. So if you do need to use a lot of credit, you also need a game plan to pay it down as quickly as possible. So the closer we get to your credit limit, the lower your score is going to be, the more drag it is going to be on borrowing money at another time. And where you're talking about refinancing, a lot of the people that are looking to refinance right now are on mortgages because the mortgage interest rate is so low. And you're not going to be able to refinance a mortgage for the lower rates if you're got a lot of usage on your credit.
But Stu, what do you suggest? And Amy, I know I hijacked your report here, and I'll give it back to you in just 1 second. But
no problem.
Stu, what are your thoughts? I guess one thing that I'm a little bit afraid of is that people are in need instead of making the difficult decision as the first decision, they're making an easy decision, which is to tap their credit card to pay this month's fill in the blank, their rent, their car payment, their food bill. Should they be putting more thought into the next 6 months of how they're going to repay that credit? What are your suggestions about some of the hard decisions before you tap that credit card?
Number one is to do a budget. The second thing is to track that budget. So we know that the most important things in our budget is a roof over our head, food in our stomachs, clothes on our backs, some form of communication and transportation. Back when I first started teaching about budgeting, I did a tracker on what I use for Dunkin' Donuts. And I know everybody hears Dunkin' Donuts stories. Well, I was spending $911 a year on coffee and bagels in the morning on my way to work. I started to get my coffee and bagels at a local grocery store. I saved myself $700 a year just by changing the way I'm bringing things into my budget. So when we do that budget plan and we start tracking it, we find where we're overspending. We might be shutting off lights more. We might be, keeping the temperature down a little bit. We might find other alternative ways to bring things that we want in our budget into our lives, like the free section of Craigslist or something like that, instead of spending our hard-earned money on it, which leaves us the money to pay down our debt, to meet our goals, or to survive a crisis like this.
So Sue, let me jump back to, so Amy, I'm sorry, I hijacked your report. Can we go back to that? I just thought I wanted just to call out for our audience, I thought that slide was really compelling. So let me give you back your thunder.
No, it's no problem at all, because ultimately the goal of this report is to engage in conversations like this. This is what people are doing. So how can they do it responsibly, and how can they learn how to make a plan for the future and the current state to then get out of it, and continue to recover. That's the goal of this report. So it's not a hijacking at all. But ultimately, if you're turning to credit, if you're not sure how you're paying bills, and I know Sue is going to get into this a little more, budgeting, absolutely super important. And I think she has a lot more to say about that than I do. But in terms of credit, one of the things we recommend is, if you are struggling to pay any bills, and if you were in the last webinar, you heard me say this over and over, if you are struggling to pay bills, especially related to credit, the most important thing you can do is reach out to your lender, contact your lender, and understand if there is an accommodation or some type of payment plan. They're pretty much the same thing, just different words, that can be made to help you get through this time, and then, maybe pay more on the back end or pay later. It extends your cycle. It doesn't, eliminate the debt entirely in most cases, but it may give you the time to build your budget, build your plan, understand how you are going to recover as your economic situation changes.
That's a great phrase of how you're going to recover. I think that if you can focus your thoughts around what is next, as opposed to merely being caught in this moment of dread and fear, that's empowering, and not feeling so victimized by something you didn't have any control over. I think that's really good. Can I pause you there, Amy? What I'd like our audience to do, so one of the, I touched on it earlier, but this middle column says that there's been a 14% have been negotiating rates or refinancing. I'd be curious if our audience doesn't mind typing into their chat, if you have personally sought an accommodation, which would mean either, if you had an amount that you owed, getting agreement from your lender or landlord to pay or a lesser amount, or to defer when you pay that. If anyone has done that, would you just type yes into your chat for me? I'd just be interested to do a quick poll, and I'll come back to you guys on that later. But Amy, please keep going. Carry on.
Yeah, I'll be interested to see the results of this poll, because our study showed that nearly a quarter of all consumers have received an accommodation. So that's a lot of people. But given that more than 50% of the American public is impacted financially, as we saw, there's still room to reach out more. It's obvious that there are people who have not received accommodations. I don't know whether that's because they haven't reached out. Maybe there are some people who are still handling things in other ways, but that's why it is important to reach out, because they most likely need to understand your situation before they're going to, offer up some kind of support.
Sue, I hate to beat a dead horse on this because we did spend an entire webinar on asking for accommodation, but what jumps out at me is if half of the country has been impacted, yet only 25% are receiving an accommodation. And we know that even though it's easy to beat up on big lenders, I think the big lenders have shown that they are very willing to extend accommodations during this time. And so what I'm worried about is our audience, that half of them perhaps could be getting an accommodation and aren't because they haven't asked. That's worrisome to me.
If a person needs the accommodation, I agree with you. The thing is, if you can work it through your budget, that is always the way to go, so that you're not owing more at the end. So when I look at the approach to taking care of somebody's financial difficulties, and I'm teaching, I want to look at the budget. I want to see what's left over in the budget. And then I'm going to look at the credit report to see exactly who a person owes. If the budget has more than enough money in it to take care of the minimum payments, you can go Susie Orman's way of doing things and pay the one with the highest interest rate down first while you're making minimum payments to the rest. You'll owe less money over time. Or you can go Dave Ramsey's way and take care of the little ones first and do the snowball effect. I kind of like the middle ground, and I think Amy would agree with me that the middle ground is getting the usage down. If that doesn't work, calling the creditors, especially right now, because most of them have been asked to work with people. If that works, great. Maybe a car payment or two could be put down on the end of the loan, freeing somebody up to be able to make their ends meet. If that doesn't work, then I look at organizations like mine and look at debt management programs. If a debt management program is proper.
Let me pause you on that. I'm sorry to interrupt you, Sue.
Oh, okay.
Let me pause you on that. I'm going to give you a quick stat on our polling. So 20% of our audience today has sought an accommodation, a little bit less than the national average that Amy would be seeing. But I think, Sue, the point you make, I think, is a very good one, and frankly, one that I missed. But the idea being that don't just automatically look for an accommodation. Look to take responsibility for your obligations first and foremost. I think that's your message loud and clear. And make sure that you're budgeting properly to accommodate those obligations. So thank you for that reminder. It's sometimes I can think of, oh, I'm getting something for free. Don't pass it up, but you're absolutely right. Thank you for redirecting me on that. So Amy, what else did your study tell us?
Well, ultimately, those were some of the big takeaways. There are, of course, takeaways around, as expected, just like I've postponed vacations and, big purchases because I'm just in my house all the time. People are postponing big purchases and things like that. But that's another way of managing their household budget, ultimately. If you're postponing a large purchase, whether by choice because you can't travel to certain destinations, or whether it's because, you're just realizing, that money could be better used elsewhere, that is also a good way to manage that budget and do like Sue said, and really evaluate which things are most important for you to pay and maintain at this time, and what your options are, across your wallet, in the whole of your wallet, to make sure that you still have things like shelter and, food to eat and things like that.
Yes. So Sue, I interrupted you and my apologies for that, but so now that Amy has set our backdrop and we understand what's happening nationally with some of these great statistics, let's I had you kind of approach it piecemeal, but let's kind of start from the beginning and really go to the core of this webinar, which is we've sought, we've sought the accommodation when we couldn't afford that obligation, and I still don't have enough money at the end of the day. Either I was denied that accommodation or I got it. But really, what do you, and I guess now they're sitting in your office, and fortunately they've found you, and not looking for some easy way out on credit repair, but they found you, you're sitting down with them, and I'm coming to you and saying, Sue, my gosh, I've done everything I can. I just don't have enough money to pay my rent. And you know what? My landlord gave me a break last month, but I still don't have a job, and I can't make ends meet. I need your help, Sue. What do I do?
And that's when we come into that tiered approach. So relooking at the budget, seeing if we can find extra spots that maybe we can plug holes with resources. I know there are food pantries out there that have geared up to help people with food insecurities, and different ways to plug holes in that budget to make the money stretch a little bit more always does help. But it's looking at the different principles and the different ways that we do things. It's like I was saying, that tiered approach. So we're going to look at that budget first, tweak it as much as we can, see what's going on, then make those calls.
So as Sue, as part of that process, are you looking at the bagel spend, bagel and coffee spend?
I might be looking at every little dime that's spent. We really do go through a budget very well. We look at different resources. We look at averages that the experts say that you should be spending, but we understand that that's not necessarily the lifestyle of the person. So we're looking at a person's inside as well as the outside, because the budget has to work. So with just put it out there with my military and veteran community, I've got over 459 different resources. For the average citizen, there are a lot less out there, but there are resources out there to plug some of those holes. So if doing it through the budget doesn't work and the person hasn't been able to get some help from their lender or whoever that they owe money to, the next step is to look at something like a debt management program. And that would be,
take me through debt management program. What does that mean?
okay, so a debt management program works differently than those awful things that we call debt repair companies or the debt settlement companies. So basically, a person entering into a debt management program, and it's always my third thing down my list, from the least effect to your score to the worst. Basically, what happens is any consumer debt that goes into a debt management program must be closed by the lenders. Okay, but the lenders bring the interest rates down to next to nothing in order to get a person out of debt in a 3 to 5 year period of time. So I usually tell people to keep an emergency card or two out and put the rest in order to keep their credit going and pay those ones down themselves while this is being paid off. In a debt management program, it is monthly payment. The person still sees their statement. It's just they're getting the lower interest rates to help them get out of debt.
Okay, so let me. I got to try to break this down a little bit more.
Okay.
Some of that went by me. So when a consumer comes to you and you've looked at their budget, tried to fill holes with public or not-for-profit resources, maybe that was a food bank in your example, maybe other resources, but first looking to aid, if you will, to help plug the gap. And then if that isn't enough, then you're going to be having a conversation with the consumer around debt management. And
that would be the next conversation I have, yes. So the debt management program, all the nonprofits basically get the same accommodations depending on a person's budget and their debt by the banks. So it's all computerized. So we can tell a person while they're going through the conversation, basically, not all of them, but basically what the banks would go down to in order to help them achieve getting out of debt.
So this was the part when we first discussed it, Sue, that was so interesting to me. So when you're describing not-for-profits, you're talking about not-for-profit counseling, credit counseling firms such as yours.
Yes.
Lenders trust you in terms of how you manage that debt management program, and they provide you, if you will, an accommodation that you can rely on as you're trying to work up this budget.
Right. 90% of lenders do work with most debt management programs. There are a couple of them that don't, a couple of them that we might need to contact to find out if they would work with us. But basically, during the counseling session, a person would know what the banks would do to help them.
And so what are the philosophies or the kind of the guiding principles behind those? I heard you say a couple things. I heard you say that the account has to be closed. What does that mean?
Meaning that any account that goes into the program, the banks make you close it. So it would not be able to be used again, that particular account. And they make it so that the person can get out of debt within a 3 to 5 year period of time by bringing the interest rates down to very limited interest rates. And when I say that, it could be anywhere from 6 to 9%, depending on the person's budget, depending on what's going in and the bank.
So the idea behind it for the bank is to say, look, we're going to help the consumer out. And we're going to, and we want, again, a principle of being out of debt or out of that debt in 3 to 5 years. And here's how we're going to go about it. But we're closing that account.
Right. But it doesn't stop the consumer from later on reopening an account with them. So it is a way of managing debt that's built up. Like I said, keeping a couple of accounts out of it so that you have emergency cards, and also so that you're paying those cards down through your budget, keeping your score growing while you're paying off debt. So that's why it's the third thing on my list.
I see. So does that mean then, Sue, if I don't close a credit card, or if I need to keep a credit card open and I owe money on that, does that affect what lenders are willing to do as an accommodation? I don't know if that quite.
No, it doesn't. And you more than likely would be looking for an accommodation before you called in. Within a debt management program, I mean, certain banks, you can't have 3 accounts with the same bank and keep one out and put 2 in. That's not going to work. But, you can keep an emergency card or 2 out of the program.
It's really incredible to me, just the resources that are available to consumers, like just exactly what you're describing is powerful, yet people look, it seems as though we're trying to educate people here and let them know that you exist, Sue, because you do such incredible work. But there's people, it seems like they look for the quick fix maybe.
Yeah, and you got to be careful.
What do the quick fixes look like in your world?
In my world, okay, most attorneys general don't like these types of people. They're called debt repair companies that basically take everything on your credit report and throw it up against the wall, whether you owe it or don't owe it. Guess what? If you owe it, you owe it through the FACT Act. It's fraud if they say that you don't. But anyways, they throw it up against the wall, see what sticks. They will charge you a lot of money to do this. And then when things come back on your credit report after it's been tracked, whether you owe it or not, because the creditors have 30 days to tell the credit reporting agencies why you owe the money or to remove it from the credit report. Usually, and Amy can attest to this, paperwork takes longer. The credit repair companies are long gone before that happens. And guess what? It shows up on somebody's credit report again because the creditor proved that they owed it. So debt repair companies, not really a good idea. You can go on annualcreditreport.com or directly to one of the 3 credit reporting agencies and dispute anything that's not yours. And it's very easy to do. Again, if you do it on annual, that's the one spot shop through the federal government for real for free. And you can dispute it right there by pulling one credit report. Say you get your TransUnion one and you open up the dispute window and you dispute an item there. They will go back to all three credit reporting agencies and the creditor for you. The creditor will have that 30 days to tell you why you owe the money or remove it from your credit report. It's 100% free, and you're entitled to another copy of your credit report. I always tell people wait 60 to 90 days to get it to make sure that it's been taken care of properly. And if it hasn't, you haven't heard back from the creditor, you contact somebody like Amy and they will make sure that it's taken care of.
So we're talking about here, so there's a couple interesting things that you're pointing out. This is really taking good care of their credit report. This isn't about saying, oh, you don't have to pay this money back. It isn't, if you owe it, you owe it. We're talking about errors on your credit report and really the self-help that's available out there. There's lots of firms out there that would like to have you pay them money to repair, quote unquote, repair your credit. And I think that's what Sue.
And it never really gets repaired.
It doesn't get repaired, and it's certainly very expensive. And the money you could have been using to solve your problem just went to a credit repair firm, I think.
Exactly. And then there's the second type of company that are debt settlement companies, where they're taking your money and they sit on it. They put it in their bank accounts and make interest off of it while they're charging you fees in order to wait until the creditor is banging down at your door to send you to court over a debt.
Wait, Sue, can you back up on that? I'm not familiar. Can you describe that in a little more detail? So this is instead of coming to you, might find their way. What's the name of that type of firm? Is it debt consolidation? What's the?
They call themselves debt consolidation or debt settlement companies.
And so
a lot of them say debt consolidation. But basically, like I said, they're taking in a monthly payment from the person. They're sitting on it and they don't do anything until the creditor is ready to take the person to court.
Wow.
Or they have gathered up enough money, and it has to be something that's far past due in order for a creditor to settle a debt. It can't be something that's open and, ongoing usage and things like that, or just went to collections. It's got to be extremely far past due. But these companies take in the people's money, and then they, at the last minute, write a settlement request for 30 cents or 50 cents on the dollar. When a person can do that on their own if they're that far past due. Mm-hmm. Now, I do have to mention a settled notation does last on a person's credit report for 7 years, having the largest effect in the first 2, if somebody did a settlement. But we know it's breaking a contract, but somebody can bring their score back up, and after 2-year time period, have a really good credit score again. So they actually could have a good credit score even prior to that if they work with their credit properly. And one of my main things as an educator for ACCC is helping people learn to use their credit properly to their vantage point, not to somebody else's. But if somebody did do a debt settlement, you got to make sure you get it in writing, because unfortunately it's with collections at this point, and you want to make sure you've got your I's dotted and your T's crossed.
That may mean, Sue, then, if I'm understanding, that if an account has gone to a collection level, you may not be interacting with the lender at all. You might be interacting just with a collection firm, correct?
Exactly. Most after 120, 180 days past due, most people will sell it to a collection agency. Some creditors will keep it in-house longer, but it will be in their collections department in-house.
I understand. So get that agreement in writing, and that's the same thing we talked about with accommodation as well. So, so now, Sue, you've done your good work. You've worked on the budget. You've tried to plug as many holes. I'm staring at a slide on my screen that says managing debt. help me get my debt down. How are we going to go about that?
Well, like I said, it depends on what is in that budget to work on. So we had the first thing that I was talking about, the Susie Armin or the Dave Ramsey or the Susie Katz way of doing it, where I'm just trying to get your usage down if you have enough money in your budget. The second tier of that is contacting the creditors. The third tier of that is contacting an organization like ACCC if the first two didn't work. If debt management doesn't work or doing settlements doesn't work, even bankruptcy is an option. It was written into our Constitution for a reason. Our forefathers believed everybody deserved a second chance, and they do. But if bankruptcy is the option, you must go through a bankruptcy court approved consumer credit counseling agency before you can go to bankruptcy court, and you must get an attorney. Our organization is nationally licensed by the bankruptcy courts to do that certification. Again, it's doing that budget and
Yep.
doing a class pre and post bankruptcy. But even if you do a bankruptcy, whether it's a Chapter 13, which lasts on your credit report for 7 years, or Chapter 7, where your consumer debt's wiped clean and lasts on your credit report for 10, the Chapter 13 being a reorganization of debt. After the first 2 years, you could buy a house if we can bring your score back up. And bringing your score and rebuilding after, you could have a decent credit score. And Amy, you can back me on this, within a year, if you use it properly. And using credit properly means low usage, you paying it off in full when you get your statement in, and just managing it properly. Whether you pay it on time, obviously that's 35% of your score. The usage is 30% of your score. Building better history. Life happens. The credit report is a picture in time. Good things will stay on it for 10 years. Bad things in general fall off after 7, with the exception of arrears child support. Most states have child support divisions that will work with people. Arrears student loans. The federal student loan program has all kinds of repayment plans. Arrears taxes, court judgments, and you can't file a Chapter 7 bankruptcy within 10 years of each other. But everything else, once you get through that, if the vultures come out after a bankruptcy, the really high interest rate credit cards and everything else, if you go to your local credit union, get a secured credit card, go to an organization like yours, have your good rent payments added to your credit report. These two types of credit, and types of credit is 10% of your score, is enough to start rebuilding. So by paying those two on time, keeping your usage low on the credit card, you actually can rebuild your score within 6 months to a year, even after a bankruptcy.
That's incredible. I consider, Sue, I find myself to be fairly well educated when it comes to consumer finance. And it's extraordinary to me of the resources that are available that I didn't know existed. And I certainly knew there were not-for-profit counseling firms such as yourself, but I didn't know that you were able to do so much. And I think what's so interesting and compelling for me today, and just listening to this conversation, is that we were talking about being in crisis, and it's not just about the COVID itself, but all of the collateral financial damage that so many of us have experienced. And I wouldn't have known to turn to you. And yet it's really what you're describing is that you're able to take someone, you're able to guide them through no matter where that outcome takes them, but it ends with a plan, and it ends with rebuilding. There's no quick fix there. And I really love the idea that no matter what that direction is, you have different approaches. And ultimately, when you talk about bankruptcy, that sounds ugly, but I understand that in some instances it's necessary.
In some it is.
Oh,
Yep. And some it is. And I'm proof of the pudding. So I've been in finance from everywhere from collections agent to receivables to payables to an operations manager of an electronics company. Been the gambit. I've restarted my life 4 times over. Every time I got better with budgeting and looking for resources, the easier it was to get through the hard times because I was able to stash more during the good times to even things out. And like I said in the beginning, life happens to everybody. Now, Dominic Williams added something to the chat room. And I do want to say opening a line of credit with a secured credit card through a local credit union, you would be able to restart your credit without having gotten a full line of credit and having a credit report pulled. This way you can start it with a low score or no score at all. This is what I use for people that never had a score before in their lives, because you build up that history and longevity. Also, having your rent added to your credit report can only help the matter because, like I said, 10% of your score is types of credit that we have. Um, for most mortgages, you need 3 types of credit. To get a car loan, you need 1 or 2 without a cosigner to get that loan. So, having something like your rent on there, having a secured credit card to start you off is only going to help you build.
Understand. Thank you. Um, Amy, before we jump into questions, and we have several to cover, anything you want to add on any of Sue's comments, anything to expand
Yeah,
on?
absolutely. Towards the beginning, we were talking about, understanding where you stand and contacting your lenders, understanding how much you owe, those types of things, right? She mentioned annualcreditreport.com, which I highly encourage everyone to pull their report. You're eligible once a year all the time, throughout history. Well, not throughout history, but going forward. But right now, given the COVID situation, all 3 credit reporting agencies are offering a free weekly credit report through annualcreditreport.com. So if you are working with lenders, planning to work with lenders, trying to build your budget, trying to understand, which creditors you need to reach out to, or, you just want to understand, which accounts you need to focus on. No matter what, this is a great starting point to start building your plan or start reaching out to your lenders or, an organization like ACCC. But it's available weekly right now through April 2021. And so, it's free. It's easy. And so, that's really the place that I encourage everyone to start, because you can't move forward until you know where you stand. And that credit report is a picture of where you stand right now.
Perfect. Sue, one thing I wanted to touch on with you, and then I'm going to cover a question, but quickly, Sue, we talked before about your fees. We talked about the cost of credit repair and debt consolidation. Can you just describe if our audience goes to a not-for-profit firm such as yourself, can you just kind of describe what those fees look like?
Sure. My organization has the lowest fees in the country, and we're very proud of that. So, a one-time enrollment fee of $39 is what we charge, and then $5 per account, capping at $50. So, you could have 100 accounts in there. You'd never pay more than $50. You could have one account, and it's $5 per month. If somebody's budget cannot handle it, we can waive enrollment fees, but it would be dependent on somebody's budget.
So great, Sue. Thank you. All right, the first question is coming right back at you, Sue. You're being asked, do you recommend a secured card first for someone who has never had a credit card before?
Yes, it's the best way to teach somebody. I'd rather them have a secured credit card on their own than be a cosigner on somebody else's account, because now 2 people are responsible for that debt. With a secured credit card, you can hold your own.
Got it. This one is aimed at me. They're asking for an explanation of how reporting rent affects their credit. So let me go ahead and, since I'm the Rent Reporters guy, I'll take that one if that's okay. So what Rent Reporters does for those who have an on-time payment history, and we can look back as far as 2 years, we can take that on-time rent payment and create a new trade line on a consumer's credit report that reflects that history. And both when we talk about how it affects the credit report, it's doing a few things. Number one, as I said, it's adding a trade line, and that's adding to the thickness of that credit file, establishing your credit worthiness. Two, it's establishing a credit history. So as far back as that lease goes, that's showing that you've had credit for that length of time. That's going to have a positive effect. And we're looking at a dollar amount of payment that's quite significant as well. Generally speaking, rent is people's highest expense. And so getting that on their credit report will have a very positive impact on their credit score. For Rent Reporters customers, on average, when we cross our entire customer base, roughly that will increase. If rent is reported, the credit score increases by 40 points. And there's obviously outliers where, particularly for someone who might not have a credit score at all because they have no credit history, those that we call unscorable, that we can take someone from no credit score, and once we report their rent, which could be 10 days, they instantly have a score that on average is considered fair, a solid score of 650. So there's lots of good that comes from reporting rent. Did I cover that well enough, Sue?
You did. In fact, I learned something from you as well. I didn't realize that it was that instantaneous.
It really is. It's the benefit of being able to report that history, that it's one of those things that you actually, if you haven't done it, it's not that you've permanently missed out. We can go back and retroactively report that for you. So
that I didn't realize.
Pretty positive. Okay, the question is, I don't know how I'm going to pay this month's rent. Any creative way of handling rent without, if I don't have the income to pay it? I'm going to ask both of you to offer any observations you have. But the first thing I would say is when you find yourself in that situation, I have to just go right back to communication with your landlord. Pick up the phone and call them. Explain your situation, explain your circumstance. That for the most part, that I think if you can try to be as pragmatic as possible, just to state the facts. As emotional as this topic is for all of us, our finances are emotional. It creates stress, anxiety, and fear. If we can just have a plain conversation with that landlord and say, look, this is my circumstance. I owe you $1,000, but I lost my job 2 months ago. I'm hoping to get back to work in a month. But describe your situation and then tell them what you are able to pay. And the thing I would ask everyone to be aware of is don't just kick the can down the road. One of the things, deferring your rent obligation for 3 months and you owe now $3,000 in 3 months, that's not a good strategy. It may provide some satisfaction in the moment, but you're going to owe that much more. So make sure that when you're talking to the landlord, that it's really about what you can afford. Is that right, guys?
Especially for renters, because the landlord, after this COVID stuff is over, could demand payment in full, versus a mortgage company that would put it at the end of the mortgage payment sometimes. So you do need to pay as much as you can and or have that discussion with the landlord. Also, there are organizations like your local church, Easter Seals, Salvation Army, that might be able to help you out a little bit towards one bill that might give you some breather room.
Got it. And don't forget, we covered this in our last webinar, but don't forget that when you're talking to your landlord, they might very well be emotional too. That it may be that they're a small landlord and they don't have the income to pay their mortgage. They're relying on your rent. So try to be empathetic, if you will, considerate of the other person, and you'll find that you'll have a much better outcome. Be kind, be caring, be forthright, and be clear about what you're asking for. Don't mix words and be embarrassed. Be direct about what you need. Another question. This is a great question. Is it a good idea to withdraw funds from a 401k to pay off bills during COVID to protect my credit score? Anyone want to get that one?
Yeah, I do not like taking money out of a house or taking money out of a 401k unless it's an extreme emergency. Your 401k, you're going to end up paying taxes if it's a withdrawal. And I need people to understand this. A loan is a loan. It has to be paid back. If for some reason you stay on furlough, you lose your job, that now is no longer a loan. It is a withdrawal from your 401k. During COVID, you will not be penalized for the 10% penalty for early withdrawal. That is a godsend. But you're still going to have the payroll taxes based on your tax status,
Exactly.
tax bracket.
But what people don't, so let me jump in. What people don't realize is that when you take money out of a 401k, as you said, you have to pay income taxes on it. And that obligation, the federal government is not very generous when it comes to forgiving tax obligations. They're not the easy one to work with. So right off the bat, you're making your situation worse, and taxes stay around forever. You don't get rid of those very easily. So number one, you're paying income tax, but to add insult to injury, what Sue's describing is there's also potentially a penalty there. So stay away from the 401k. That should be absolutely last resort. You've worked hard to build up that nest egg. Keep it there, focused on your budget, like Sue's been saying. Do you accept that, Amy?
Yeah, 401ks are an investment in your future, so don't leverage your future as much as possible on the current state. Try to find other alternatives if you can.
Yes, and sometimes you'll hear about being able to take loans out. Avoid those too. They don't have the income tax impact, but you're just keep your future, as Amy said. Keep that tucked away safe. Follow-up question for Sue. You're very popular, Sue. Feelings a little bit. No one sends questions to me. I think the rent question just might have been a plant or something to make me feel better. All right, follow up. You said a secured card would be better than being a cosigner. If I am already an authorized user on my parents' credit card, should I remove myself from those or keep it? Do those help or hurt my individual credit? So that's a pretty complicated question, but a really good one. Basically,
it really isn't that complicated.
Go at it.
So a cosigner is a different vehicle than being an authorized user. The authorized user is not responsible for any of the debt at all. Your parents are. Do you like that idea? It will flow through their good credit onto your credit report. It is a way of helping you build credit. But if you do use it, please make sure you pay your parents back because they're the ones that are responsible for that debt. Should you be removed from it? You know what I would do is I give them the card back and just let it sit on your credit report. It is not going to help you for all forms of borrowing in your future. A lot of mortgage companies will not use authorized user as a means of showing your good credit history, but it does help you with the smaller cards.
So it's no harm in keeping it there, but I think what you're saying, Sue, is that you do want to start building your own credit, and maybe that's your credit card, maybe that's just your own credit card, if your credit allows you to do that.
Yep, and Amy might have some input on this one as well from her point of view.
Yeah, I do. If you're already an authorized user and you're using it responsibly, your parents are fine with how you're using it. And if they have, relatively good credit and you're using the credit responsibly, having that card open, whether you are or are not using it, is with your name still on it as an authorized user, can be useful in helping to build your credit history, especially if, as your previous question indicated, you may not have had a credit card before or any other credit. So if that's the way that you're starting to build your credit history, that can still be useful. But then, once you're ready and feel responsible enough to take ownership over a secured card, that will help you to start build your own individual credit history, and both will be on your report, which then serves to increase, your credit history and credit reporting there on your report. So both could potentially help you as long as always, you're responsible with that credit spend.
Back when I was building my credit, I built it in the most, I was so proud of it, and my friends never really respected it per se, but I actually ended up buying a gift for my girlfriend at a jewelry store, and they offered me a loan to pay for it. And it worked. My girlfriend loved the present, so that was great. But it was an unusual way. But all of a sudden, I had this trade line, and I was able to start to build my credit through. It was a very modest. It was a couple $100 loan, but it really had a big impact on my credit. It's a little bit off.
I laugh at things like that because most store credit cards are 21.99% interest just to start.
Oh, dang it. I wish I knew that.
Back when I started mine, it was a Sears card. And if you got Sears back in the 70s, you could get anybody's credit card.
I do remember that. Okay, last question, and we're going to be out of time. And I think this is going to be for Amy. For credit cards, what percentage would you advise as the right credit usage percentage? What should their target be? If it's not zero, what do you suggest in difficult times? Keep it below what?
Sure. Keep it below 30%, if at all possible. That's kind of the expert advice, general, what people are looking at, what your credit score factors are looking at. And so if you can keep it below 30% for the total of all your credit cards. So it's not 30% of each credit card. So if you have one credit card that has a lower interest rate or, that you just like using because you get points, that's fine. It's of your total credit card limit. So add up the totals of all of your available credit on your credit cards, and then divide that by your total balance, add it up. That's how you get to that 30%.
Got it. And with that, you already saw, Sue, your information was up on the slide. We're going to send that back around at the end of this webinar. We had quite a few questions we couldn't respond to today, but we'll get those out in writing as we promised. And if you have any questions, shoot it out to info@rentreporters.com and we'll get right back to you, or pick up the phone and give us a call or go on our website and chat with us. Amy, Sue, thank you so much. And everyone, thanks for attending this webinar. I really enjoyed the topic. I hope it was helpful for everybody. I know I learned something, and we'll be back at you with another installment soon. So everyone, take good care of yourselves, take good care of your finances, and take good care of your families.
Thank you for having us.
Thank you.
Thank you for having us. Bye.